We've got to start with where we are with the banks, plural, you'll notice, because you've had a lot of banks that are having big problems with their stock price right now. You've had temporary trading halts in dozens of banks. Some of them had shares falling 50, 60, even up to 75% when the markets opened at 9:30 a.m. Eastern today. Now, Joe Biden is out there telling everybody that your money is safe. Don't worry about it. It's all going to be fine. This is clip 3. Joe Biden telling everybody the government is covering deposits. Play 3.
All customers who had deposits in these banks can rest assured. I want to rest assured they'll be protected and they'll have access to their money as of today. That includes small businesses across the country that bank there and need to make payroll, pay their bills, and stay open for business. No losses will be, and this is an important point, no losses will be borne by the taxpayers. Let me repeat that. No losses will be borne by the taxpayers. Instead, the money will come from the fees that banks pay into the deposit insurance fund.
Okay. Let's just start with basic facts here. This is a bailout. They're saying it is not a bailout, but this is a bailout. They're just trying to structure it in a way that it seems less like the downside here for Silicon Valley Bank is being socialized, right? The upside is all capitalism. We're geniuses. We get to pay ourselves huge bonuses. The downside, the losses are socialized. It's, whoa, this is society's loss. And it's interesting because Silicon Valley Bank had been lobbying for years that it was not necessary for it to have the same stringent balance sheet requirements and risk management requirements because it wasn't a systemically important bank, an SIB, that it was a bank that should be able to operate a little more on the edge. Well, now it has fallen off the edge, and we are told that there has to be the government swooping in. Janet Yellen says there will be no bailout, but that's not really true. Play clip 1.
Let me be clear that during the financial crisis, there were investors and owners of systemic large banks that were bailed out, and we're certainly not looking, and the reforms that have been put in place means that we're not going to do that again.
But they're kind of doing something similar. Here's what's happening, and it's complicated, and I know that there are a lot of competing narratives, a lot of things you're hearing out there. First of all, over the weekend, the big debate was, should you just let the bank fail? And should the depositors have to deal with the fact that they now have effectively an IOU beyond the guaranteed $250,000 per account that the FDIC insures, that they would have an IOU when the bank assets would be sold or what they have been sold. They were selling them at auction effectively. Because once you understand what really happened here, it becomes more clear how it is that this could happen, first of all, at other banks. And also, I think everyone understands the politics that are at work. But effectively, you had the IOUs that they would have instead of. So if you have $1 million in the bank, right, 750,000 of that is. Wait, am I getting that right? Yes. 750,000 of that is insured. Not insured. So you have $250,000 that are insured by the FDIC, $750K, you're on your own. You'd have some share that the bank's assets, Silicon Valley Bank, would supposedly pay back to you at some point. You'd recoup the money at some point in time. And that's not good enough because for a lot of small businesses out there that were banking with them, just parking their money with them, they got to make payroll. So that's not going to work. So they need the money now. So what is the Fed doing? The Fed is taking onto its balance sheet the treasuries, particularly, that Silicon Valley Bank bought in order to make more yield on the money that it was given. And they're buying it at this point in time, taking onto the Fed balance sheet. So really the government is, in effect here, stepping in some capacity. And it is a bailout. I mean, they're going to call it all these different things, but if it was left to its own devices, you would have to have a liquidation of the bank and all the rest. And that would be a problem for a whole lot of people right now with $200 plus billion of assets, there's a lot of money here that is at stake for people, right? So now you have why is it that we have a $250,000? People are asking this question over the weekend. There's a lot of questions here, by the way. I mean, this is fascinating. And I haven't even gotten into, is this going to get a whole lot worse? And even if it doesn't get catastrophically worse immediately, what are banks going to do in response to this? Everyone says, oh, they need tighter regulations. You know what's going to happen? Less lending. Oh, gee, that means less credit. What do we think less credit does to the economy? You think that's going to be a fun one? The original sin of all of this, the original sin was creating artificially low interest rates, which effectively destroyed the bond market through the machinations of the Fed and the federal government, and then printing trillions of dollars. That's the basis for all of this. That's how we even got into the mess in the first place. Now, some people are going to say, Buck, the Jekyll Island and the beginning of the Federal Reserve. Okay, but I mean the recent basis for all of this. The bill is coming due for that. That's what you're seeing right now. It turns out that if you manipulate the market as a function of government policy, so you have artificially low interest rates, because you're trying to keep stimulating the economy with more and more money, and you're putting more money into the economy, and people can't actually get any yield for the money that they're putting into, well, banks, but also bonds. Because those interest rates are so low, you create economic dislocations. You create a market that is inefficient and that can have both bubbles and collapses. Bubbles and collapses. Doesn't that seem like something we should all pay very close attention to right now? But so over the weekend, there are people arguing this is just a bunch of Democrat fat cat donors who run Silicon Valley Bank. They should bear all of the consequences on their own. And if you're a depositor, too bad. Well, the problem with that is Silicon Valley Bank's not the only one that it seems got on the wrong side of investing in treasuries, taking these long-term investments that allow them to get some yield on the money that is deposited with them. So they're on the wrong side of this. Like other banks are on the wrong side of this. There's a very rapid run on the bank, $40 billion in one day. People saying, we want our money out. We want our money out. If this happens at other places, then you've got not just a financial crisis in the making, you have a financial catastrophe. Because you're going to have people that aren't going to have access to pay bills and pay staff and employees right now. And maybe it gets unwound in the next 6 months or they figure it out down the line. But what happens in the meantime? Job losses, economic destruction, bad things. On the other side of this, there are people who keep pointing out, though, so the way the system seems to work is we say that your accounts are FDIC backed up to $250,000. But really, the banking system is such now that you're unlimited as long as there's a politically potent narrative behind it, you're unlimited in what the government will backstop for you. Right? It's so why even have the $250,000 limit for FDIC? Also, kind of an arbitrary number, isn't it? What's that really all about? And when you start to look at this, you see the banking system, a lot of it is based on, operating as a big black box. People don't really understand. There are people who are arguing, well, you should lose all of the money that you invested in Silicon Valley Bank because they didn't do, meaning the depositors didn't do the due diligence to know what the bank is really doing. Okay. Does anybody do the due diligence before they invest in a bank that is capitalized and FDIC backed and et cetera? I mean, we got to really think about this. Does anyone do that? Does anyone even know how to do that? I mean, if you told me I had to do due diligence on JP Morgan Chase or Bank of America or, Wachovia or what these massive banks, where do you start? You kind of assume, and this is the bottom line truth of it all, you kind of assume that there are adults in charge and people more or less know what's going on and that it'll all be okay. The whole system is based on trust. That's the whole banking system, really. Ultimately, it's trust. Otherwise, it's numbers on a computer screen. We're not even really trading in hard currencies. You're not even really going to the bank teller anymore. When was the last time you even went to a bank? Not an ATM machine, a bank. And did anything else. You'll say, oh, well, a month ago or 6 months ago. Okay, some people might say, been a few years. So how much due diligence can you really do with all of this? So, there's many layers of this. There's what is it going to do to the economy? Big piece, right? What is the Biden administration doing about all of this? And they're a bunch of incompetent buffoons. We know that. Who is going to pay? Who is getting bailed out? How much worse can this get? These are all questions that are still being answered. And one thing that keeps a thought that keeps bouncing around my head on all of this is if you were looking for the match that could start the conflagration of a major recession, a 2008 style recession, a series of bank failures. By the way, it's not just SVB that has failed. There are 3 of them, I believe, now that have officially failed in the last few days. And a whole lot of other banks are under tremendous pressure right now in terms of their stock price because people are worried about them. Wouldn't this be, if you were wargaming as an economist or somebody who just wants to know where the country's going, if you're going to wargame how things get really ugly economically really fast and how you could have massive spikes in unemployment and a huge depression in real estate prices, and just go down the list, all the things, all the reset mechanisms in an economy that has been overheated and just full of bubbles. If you were getting ready for that, or if you thought that was coming, wouldn't a series of bank failures be one of the most likely ways that it would begin? That's a thought that keeps bouncing around my head. I hope it is not true. I hope that this is relatively contained, and it may be, but no matter what, it's a reminder of how fragile this whole system is. Jim Cramer was on TV a month ago telling people, the guy on TV is like, hey, buy this, buy that, honk, honk, and he's like playing the noises and the bull noise and everything else. He was telling people to buy SVB a month ago. This is a problem with reliance on experts and adults in the room. People are greedy. People are fearful. People do not want to be held accountable when they make mistakes.
As you know, the New York State Department of Financial Services took possession of a New York chartered bank known as Signature last night. While that sounds extraordinary, that is what happens in terms of the transition from a temporary hold by the state, and it's immediately turned over to the FDIC. Our view was to make sure that the entire banking community here in New York was stable, that we can project calm, that this is a time when we could manage a certain narrow situation and to make sure that that did not get any worse.
Yeah, that's right. The governor of New York, Kathy Hochul, talking about why a New York-based bank there was also taken over by the government. And Kathy Hochul is an imbecile. So is there any reason to believe that she has any idea what the heck should be done here? And we're talking about the banking crisis that perhaps is averted. We shall see in the days ahead. It definitely hit harder this morning when trading opened than I think certainly the Biden administration expected or was willing to let people think they expected. Not quite the same thing. They're trying to stop a full-blown financial crisis. One thing that I do believe is very interesting about what happened here in Silicon Valley Bank is that it had invested in, right, and this is where we all go back to the banking 101 stuff, but it had invested in pretty secure stuff, and that's actually what's at issue here. Treasury bonds, I think it was 10-year treasuries they were in, but because of all the Fed interest rate swings, they got on the wrong side of it. So their bonds, their 10-year bonds were worth less. They went below par because of the raise in rates, right? Rates go up, bond value goes down. So that was an issue. That was a problem for them. And then what happened is word got out when they were trying to raise, Silicon Valley Bank was trying to raise $2 billion of capital so that when people are going, they're taking out, 10 grand or 100 grand, or if they're running a business, payroll, maybe $1 million for the month, whatever it is, that the capital would be in the bank to give to the people who were depositors and not force the bank to sell the treasuries, the billions and billions of dollars of treasuries it had invested in for a loss, right? Because they had to take them, if they have to take them out early, instead of getting a nice, whatever it is, 4 or 5%, they were going to be selling them at a loss. And so there wasn't the money, or there wasn't going to be the money for people to take out. Once the word got out about the $2 billion, and this is another part of it, that spread like wildfire. And Peter Thiel, who I, through a friend, tried to reach out to see if he'd come on to talk to us about exactly all this stuff. And if Peter's listening, please do call in. We'd love to talk to you. He told his investment fund last week, I think it was on Thursday night, this bank is unsteady, on the brink of collapse. Take out your money. Well, this word can spread very fast. You've got social media now. You've got Twitter. You've got people who are able to figure out really quickly. And so there were lines of people to take out money from the bank right away on Friday. And now you got into the debate over the weekend, right? So anyway, that's how this whole thing happened. You had a flash run on Silicon Valley Bank as a result of getting on the wrong side of its treasury investments, and the result of trying to raise $2 billion to keep enough cash flow in the bank that people could take out the money that they had put into the bank. Then all of a sudden you have a run, right? A bank run is everyone shows up, says, I want my money. The bank says, well, we don't have the money to give all of you. We have money to give you over a period of time at a rate that we expect, but we don't actually have. And this is where you get into fractional reserve banking and some of the problems, some of the fractures in the fractional reserve approach. And so now this morning we wake up and you've got, First Republic Bank stock getting crushed. You've got a lot of these different banks, regional banks, that are under tremendous pressure in terms of their stock price. So the government says, well, the depositors are all secure, that there's a backstop. They say it's coming from fees, but fees that the banks pay into a fund will just turn into fees that people investing in or giving money to the banks will end up paying. The costs will be borne by the people. I mean, that's the bottom line of this. Whether it's a Fed balance sheet trick or it's banks paying into an FDIC fund to make sure that there's effectively insurance on the, additional insurance on the insurance, if you will. I mean, whatever games they're going to play on the balance sheet, at the end of the day, this will be an expense that is passed well beyond Silicon Valley Bank and some of these other banks. And that upsets people. That upsets Main Street folks. That upsets people that are sitting here saying, okay, so I'm having trouble paying my mortgage. I'm going into credit card debt to buy groceries for my family. The people running Silicon Valley Bank not only pay themselves, I'm talking now about the executives, right? Not only pay themselves exorbitant fees, in particular for doing riskier stuff, right? There's a venture. They do a lot of business with venture capitalists. There's a venture, as in like adventure, component to the way that this bank was operating. So the upside for they're geniuses when they're making all this money, right? Oh, we deserve our $10 million bonus or whatever it is, right? I deserve, and I think it's a lot more than that for many of them, but we deserve the money we're making because we're so smart. And then when they're idiots and they destroy their whole bank, it's, oh my gosh, you better bail us all out or else all the banks are going to go under too. Well, hold on a second. There has to be accountability. And I think that's where, for people, and a lot of folks are paying attention to this, because you're talking regional banks, dominoes falling, depositors being left out in the cold. Everyone's paying attention to this. This matters. When you're talking about someone's money, their life savings, their ability to pay the rent, buy gas and groceries, people pay attention. Where's the accountability? Is there ridiculous stuff out there about how SVB was focused on diversity and inclusion stuff, and some of the people in risk management at the top of the bank are, out of the woke academy for lunatics? Yeah, of course that's there too. And is that an indicator, I think, of why this diversity and inclusion obsession at major institutions, it's going to cause problems, whether it's, for how we hire airline pilots or who's doing air traffic control or who's in charge of train safety. Just talk to the folks of East Palestine about that one, or now the banking industry. When you elevate for reasons other than basic competency in the field, bad things happen. So that's a part of this. But there's another layer here is, well, how do you punish the banksters, if you will, the people running it who are supposed to be preventing this kind of a thing? How do they get fined? They were selling their stock, by the way, millions of dollars of stock sold by bank insiders at Silicon Valley Bank in just the last 30 days. Oh, gosh, I wonder if they realized they had a problem. How is that legal, by the way? Is it? That's another question. But assuming it is, how would that be legal? Think about that. Oh, yeah, no, we'll take your money. We'll take your money. I run the bank and I'm selling my shares in it, but give us your money. It's fine. There's both a selfishness and an arrogance there because they must know at some level that they will be bailed out. And they're right. But the problem for the people who are saying, oh, but, the FDIC insurance and, whether it's insurance for, per depositor. So if it's a husband and wife in the account, it might be more, whatever. It doesn't cover, the FDIC obviously doesn't cover the range of the $200 billion in assets. That much we certainly know. And people are saying, well, too bad. You didn't do your homework. You're a depositor. Figure it out. Yeah, you'll get back something. Maybe it's 60 cents on the dollar. Okay. But do people really, when they give money to a bank, do they think that their capital is being deployed in a fashion that is so reckless that now there are times in the past where that's happened, and we go back to the Great Depression and we go back to the various stock market booms and busts. But we have all these regulations, right? We have government backstopping. That's not supposed to happen. And if you were to say, let the regional bank, this is where it gets more complicated. I know, the people that are shouting, this is actually a difficult issue. There's a lot of things happening here. It's not as straightforward as just, there's this one issue. There's a lot of issues. Because if you start letting regional banks fail, not only do you probably set yourself up for a depression, I mean a straight up depression. Unemployment gets up to 10, 15% in the blink of an eye. I mean, if you start letting regional banks, because you think Silicon Valley Bank is the only one that got on the wrong side of the interest rates and could be subject to a run like this? Clearly not, or at least clearly the market perception is that that's not the case. But what do you do then? Okay, well, you then just pile all the money. Everyone's going to want to move all their money into the systemically important banks, the too big to fail banks. You all know what they are, Bank of America and JP Morgan, et cetera. You go down the list of the biggest banks in the country. So is that better? So then we pool all of our money into these mega banks that are engaged in all kinds of ESG and other stuff. It's not exactly a solution either, is it? Well, it would have been a better idea all along to allow the market to function as it functions and not allow politics to determine artificially low interest rates and trillions of dollars of printing so politicians can make people think they are richer than they are and the economy is better than it is. Cue Joe Biden and his speech this morning, by the way. That's exactly what happened there.